dynamics today, as you might expect, with this massive rotation. It seemed almost like the maximum pain trade with energy and cyclical stocks declining, the old discarded growth names rebounding quite a bit. I know you sort of have a sense that we're likely already in a recession. What does it mean if that's the case for an investor looking at the risk reward available to us in this market?
So I think that what we're now facing as we head into earnings season is a likelihood that even subdued expectations of minus 2.5% S&P earnings, excluding the energy sector, that re-rating still has to go lower. But when you have an environment where earnings growth is dear, that means that growth stocks that actually have earnings growth, not just your standard label of growth stocks based on sectors, they get a bid. And I think that may be some of why we're seeing some of these growthier areas and growth factors start to perform a bit better. I also think that if a recession is sooner rather than later, I'm not so sure that's such a bad thing. I think with the retreat in oil prices, we're sort of maybe witnessing the feature aspect of a recession versus the bug aspect of a recession in bringing inflation down sooner rather than later.
Yeah, and it seems remarkable how quickly the market is willing to shuttle from one worry to another within a few months, which of course leaves open the possibility that it overshoots along the way, at least, in the short term. And I'm wondering how you might distinguish between the growth scares that we got, in 2011, that kind of muddled through period of time when, things got priced pretty much like a high likelihood of recession was at hand. And we didn't quite get there statistically. And yet, so the market was able to kind of gather itself up, and something that would be a true recession where you did see across the board decline in employment and earnings and things like that. Is that a distinction without a difference at this point?
Well, I think a key difference between 2011 period and the current period is the 40-year high in inflation and the fact that the Fed's in a very aggressive stance right now, seemingly with just an eye on only one mandate. And I think until we see a meaningful move down in inflation, their eyes will only be on the mandate, even as or if we start to see deterioration in the labor market. You also had the debt downgrade, so there were other exogenous forces at play in the 2011 period.
And what would you be looking for right now? Obviously credit spreads are now in focus. They've not been particularly friendly to equities. You've seen the yield curve flatten out again. Is it just about kind of being patient and waiting, or are there tactical opportunities that you would advise people consider?
So I think, as I mentioned, you may have a sort of a growth factor trade. I want to make sure we differentiate from saying, just blindly buy growth indexes. I think when you look at the factor level, even in sectors that don't happen to live in the growth indexes, I think that trade probably has some near-term legs as we get into the start of earnings season and get a sense of what the haircut is going to be to earnings. I still think you want to have sort of this quality wrapper around. You want a strong free cash flow yield, healthy balance sheet, cash-rich balance sheet, but that kicker of positive earnings revision, profitability type factors, I think are rightly so in play at this point in the cycle.
Are you having to, in general, pay a big premium for those characteristics at this point? Because it would seem as if they were inexpensive, it would be a complete layup, and there would be really no opportunity cost to doing that, even if we get, a rebound in the economic activity.
Well, actually, I think what's become more expensive are the classic defensive areas. Utilities trading at a multiple above the S&P. Just because they live in the value indexes doesn't mean they offer a lot of value. It also doesn't mean they're growth stocks. And as we've seen, there's been the movement on the part of Russell because of the carnage in some of these growthier areas. You've now got some typically seen as growth stocks moving now into those value indexes. And you saw some traditionally value areas like utilities move to pretty rich valuations. So I actually think we've seen a narrowing in this spread, which is why I think you want to take kind of a hybrid approach. You don't want to just look exclusively for that growth kicker. You want to still keep an eye on valuation. And that hybrid approach, I think, is the right one to take at this point, for stock pickers anyway.